G'day Gain Squad, it is Goldie Gains here and we are back in the Sydney studio for a massive update. The US and Iran have reached a ceasefire in the Middle East. A 2-week ceasefire deal was reached just before the deadline thanks to Pakistan. The markets have reacted massively today, with gold and US tech stocks soaring while OIL plummeted. Today we are unpacking the news, the market moves, and what's the next move if this ceasefire lasts. We are also diving into the energy stocks that are set to skyrocket as the Persian Gulf infrastructure gets a hammering. And of course, we're looking at why the Magnificent 7 tech giants are finally starting to lose their iron grip on the S&P 500. Just a quick reminder that this isn't financial advice, so do your own research before you go throwing your cash around. Here is the big question for the smart money. Is gold about to smash through the $5,000 ceiling this week? Let me know what you reckon in the comments below, and don't forget to smash that like and subscribe button right now. Starting with the breaking news from April 7th, the situation in the Middle East has absolutely gone off the rails, gold getters. President Trump has issued a final Stone Age ultimatum to Iran to reopen the Strait of Hormuz immediately or face total destruction. Reports from late April 7th indicate massive explosions have rocked Iran's Karg Island oil terminal, which is a major blow to their exports. The US and Iran have officially reached a 2-week ceasefire deal to end hostilities and open the Strait of Hormuz. On April 6th, Iran explicitly rejected the initial ceasefire proposal, demanding full reparations for the damage already done to their infrastructure. A last-minute intervention from Pakistan mediating an agreement just before the deadline to allow diplomacy time to work has won the day. Traders are absolutely on edge, as 1/5 of the world's energy supply will reopen to global markets for the next 2 weeks while talks continue. The suspense is reaching a fever pitch because the White House had threatened to destroy any remaining infrastructure in Iran, with B-52 bombers on the way to Iran prior to the last-minute ceasefire. By April 8th, the Asian session saw gold prices react violently to the uncertainty, hitting an impulse high of $4,813. When things get this spicy on the global stage, physical gold becomes the ultimate insurance policy for any serious portfolio. We're seeing a classic flight to safety, as the market realizes that the era of low-cost energy stability is officially dead and buried. Every headline out of the Persian Gulf is acting like high-octane fuel for our favorite yellow metal right now. Now let's talk about the black gold, because WTI crude oil is having a proper wobbler of its own this week. On April 7th, oil prices briefly spiked above $115 as the risk of a total energy lockdown became real. The OVX, which is the Oil Volatility Index, has exploded to a reading of 108, which is 3 times higher than January. This level of volatility is making it incredibly expensive for companies to hedge their fuel costs, which is driving inflation through the roof. While Trump claims the US doesn't need the Strait of Hormuz because of domestic production, the global price impact is still massive. Today, WTI plunged to $92 a barrel on news of the ceasefire deal. This geopolitical energy volatility is a double-edged sword for gold, creating inflationary support while also giving the dollar a reason to stay strong. For our energy traders, the OVX is the main chart to watch because it is signaling that these wild swings are here to stay. If the blockade is ended permanently, inflation will fall and oil prices will return to slightly above pre-war levels. Much of the Middle East infrastructure will be under repairs for the next 2 years. The market's having a bit of a wobbler because nobody truly knows how long this military campaign is going to last. Is this ceasefire the end, or just another day? Moving over to the tech world, the Magnificent 7 stocks are finally showing some major cracks in their fortress reputation. On April 7th, Apple led a massive tech tumble, dropping 4.55% in a single session as investors ran for cover. Nvidia and Microsoft are also feeling the heat as the massive spending on AI infrastructure starts to face some serious skepticism. The market is worried that the multi-billion-dollar investments in data centers will take way too long to actually pay off. We're seeing a rare shift where the big tech names are actually dragging the S&P 500 down rather than lifting it up. The total market value of these 7 giants has shrunk significantly since their peak, losing hundreds of billions in just a few months. Smart money is starting to rotate out of paper wealth and into hard assets, like gold and energy producers. It's a classic rotation that usually happens when the economy starts to feel the pinch of high interest rates and war. Even Elon Musk's Tesla is struggling to find its footing as the broader market sours on growth-heavy tech stocks for now. If this trend continues, the dominance of the Magnificent Seven might finally be coming to a much-needed structural end. Now, let's do a deep dive into the energy infrastructure play, because there is a massive opportunity hidden in the rubble. Independent researchers at Rystad Energy have calculated that the repair bill for Middle East infrastructure could exceed $25 billion. Qatar's Ras Laffan industrial city has seen its LNG capacity slashed by 17% after recent military strikes. This destruction is creating a huge bottleneck in the global gas supply that could take 3 to 5 years to fully restore. For the gold getters looking for a hedge, the companies that specialize in oil rig and refinery reconstruction are the ones to watch. Multinational engineering giants are already lining up to assess the damage to pipelines and gas liquefaction plants. Every day that the Strait of Hormuz stays closed, the pre-war production capacity of the region gets further out of reach. This means that energy prices will likely stay higher for longer even if a ceasefire is signed tomorrow. We're looking at a fundamental shift where energy exporters outside of the conflict zone are seeing their valuations go vertical. Companies like ExxonMobil and Shell are moving quickly to protect their global investments and capitalize on the supply gap. The destruction of Iran's South Pars gas field is a multi-year disaster that will require tens of billions in new contracts. If you are looking to optimize an entry, keep a close eye on the shipping and marine salvage specialists who clear bombed-out ports. These firms are effectively the first responders of the financial world, and they are about to be very, very busy. The post-war cleanup will be just as strategically important as the conflict itself for global trade influence. It's a proper golden entry for anyone who can spot the engineering firms that are essential for regional energy stability. Let's talk about copper, because the Doctor of Economics is starting to write a very interesting prescription for the market. Copper prices climbed toward $5.67 per pound on April 8th as risk sentiment improved slightly. There is a lot of chatter about a potential 45-day truce, which helped copper futures rebound from their recent lows. However, copper is still down for the year because inventories at the London Metal Exchange are sitting at 6-year highs. It's a bit of a tug-of-war between the massive supply in warehouses and the strategic demand for the energy transition. Copper usually moves in the same direction as gold, but it is much more sensitive to the actual health of the global economy. Right now, the copper-to-gold ratio is quite low, which tells us that the market is still leaning heavily towards safety over growth. If copper can break and hold above $5.75, it might signal that a broader recovery is on the cards. But as long as the Middle East is on fire, copper will likely remain the underdog compared to the yellow metal. Watch the copper prices closely, because they'll tell us when the world is actually ready to start building things again. Back to gold, the price action between April 6th and April 8th has been nothing short of breathtaking for us traders. We saw gold stabilize firmly above $4,800 after Trump's initial speech signaled a prolonged campaign. The core driver has shifted from immediate panic to a long-term realization that the US dollar is facing a debt wall. There is a massive $90.5 trillion debt maturity coming up in 2026 that the US government has to refinance. On Wall Street Bets, the gold getters are calling this the mathematical certainty that will eventually send gold to the moon. The US Treasury is in a real bind because they have to roll over this debt at much higher interest rates than before. This is known as fiscal dominance, where the Fed might be forced to print money just to keep the government solvent. This narrative is exactly why central banks are dumping their US Treasuries and loading up on physical bullion instead. For the first time since 1996, gold has actually overtaken US Treasuries in global central bank reserves, which is a massive milestone. This isn't just a hedge anymore. Gold is becoming the primary macro asset for the world's most powerful financial institutions. While the dollar index is trying to hold its ground at 100, gold is ignoring the traditional rules and moving higher anyway. On April 8th, the market closed near $4,705, defending the recent gains with serious conviction. Even when the job data came in hot, gold buyers stepped in to protect the value area, showing how strong the demand really is. The sentiment on the ground is that any dip is a gift from the market gods for those who missed the January rally. It's a buy the rumor, buy the news kind of environment because the structural bull case is just too strong to ignore. We're also seeing a lot of short covering, as the bears realize that betting against a world in crisis is a losing game. If the Strait of Hormuz opens for the next 2 weeks, the floor for gold might move down another few $100s, presenting a new chance to buy the dip. Retail investors in India and China are also buying on every minor pullback, providing a solid global support base. The price of 24-karat gold in major hubs like Mumbai is reflecting this same resilience despite the volatility. It's a global phenomenon that transcends any single currency or border, which is why we love this metal so much. Every time the White House chickens out, the smart money just buys another bar of the yellow stuff. The geopolitical risk premium is currently estimated to be at least $300 per ounce above the fair value. But in a world where civilian infrastructure is being targeted, fair value is a very subjective term for any investor. We are watching the markets react to the ceasefire deal in real time. The charts are moving with massive swings. Oil, gold, US shares, all moving on the breaking news and any signs of either side not keeping to the agreement. Trump's word is only as good as Trump stakes, Trump University, and Trump coin. It only has value, as people believe it does. The Stone Age rhetoric is scary for the world, but it is the ultimate marketing campaign for precious metal sovereignty. Traders are no longer asking if gold will rise, but rather how fast it will reach the next big psychological level. We've optimized our entries around the 4,650 level and it has paid off beautifully this week. This is a proper golden entry for anyone who stayed disciplined during the messy March correction we just went through. Don't let the short-term noise rattle your nerves. The big picture has never been clearer for the gold getters. We are seeing a fundamental repricing of risk that only happens once or twice in a generation, and you are right in it. The Magnificent 7 tech stocks might be the old economy now, while gold and energy are the new reality. Keep a close eye on the total volume coming into the gold ETFs, because it is showing consistent institutional restocking. They aren't just trading the news, they are building long-term positions to protect against a potential dollar debasement. The war shock from earlier in the year has been absorbed, and the market is now focused on the kinetic war in the Gulf. It is a high-stakes game, where the winners are those who own the assets that can't be printed or bombed out of existence. The resilience of gold in the face of rising bond yields is the ultimate proof that the old correlations are starting to break down. We are in uncharted territory, and that is exactly where the biggest gains are made if you have the courage to hold. Stay sharp, stay focused, and don't let the wobblers in the tech sector distract you from the main event in the metals. Let's optimize this entry with some quick technicals. The impulse to 4,813 was a major signal. The RSI on the hourly chart is sitting below 50, which means we are technically in neutral territory. I'm looking for a constructive retest of the value area, high near 4,752 to reload. If we can hold that support, the next major objective is the resistance zone at $4,900. The 50-day moving average at 4,694 is acting as our primary pivot for the week. Bollinger Bands are widening like crazy, signaling that the volatility is currently running at double its historical average. We have a strong buy signal on the weekly and monthly charts, so the long-term trend is still firmly in the bull's favour. Watch for a bullish engulfing candle on the 4-hour chart to confirm that the next leg of the rally has officially started. Just remember to keep your stops tight, because the headline risk from the Middle East can change the direction in seconds. To wrap up, the US-Iran war is the primary driver for gold hitting its recent highs of 4,800. Oil volatility is through the roof with the OVX at 108, which is keeping the global energy markets in a panic. The Magnificent 7 tech stocks are losing their luster as investors rotate into hard assets and reconstruction-related energy plays. There is a massive repair bill coming for Middle East infrastructure, which is a multi-year opportunity for engineering and logistics firms. Central banks are choosing gold over US Treasuries for the first time in decades, creating a massive structural floor for the price. Copper is trying to rebound on ceasefire hopes, but the high inventories and low ratio to gold show that caution is still king. The technicals suggest a small correction is healthy before we make a run for the psychological $5,000 mark. So, what comes next? Will Trump stick to the ceasefire agreement, or are we going to see another clash in the Strait of Hormuz? Do you think gold hits $5,000 before the end of the month, or is the dollar about to make a massive comeback? Drop your predictions in the comments below. I want to see what the smart money is thinking about this war-torn market. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!